Hello everyone, my name is Jake and welcome to Growth Academy. If you're new, please consider subscribing for more content like this one. Over the last 3 months, Chinese equities have dropped repeatedly. Many investors have taken advantage of this low pricing in the hopes of making long-term returns. On the opposite end of the scale, many investors feel that China is overly risky. Cathie Wood is in the center of the range since she sold her Chinese equities, but just repurchased them using a very innovative technique. This video will go into detail on the future of Chinese equities and discuss all sides of the China argument. For a legitimate reason, Chinese equities have dropped significantly. New restrictions on education, gaming, data privacy, monopolies, exclusive contracts, and U.S. IPOs have been implemented. For many investors, the idea that all of this has occurred in a few months is terrifying. The Chinese Communist Party can devastate Chinese stocks with the flick of a finger. Chamath Palihapitiya, a wealthy venture investor and SPAC sponsor, feels that the risk associated with Chinese assets is just too great to justify the investment. Chamath is particularly worried about the variable interest entity (VIE) structure utilized by Chinese businesses to go public on the U.S. stock exchange. So, what is a VIE structure? Many individuals talk about VIEs, but they seldom explain the risks of investing in them or how they function. Foreign investors are now prohibited from investing in most Chinese sectors. As a result, Chinese firms have exploited VIEs as a way around this limitation. In the following example, we will utilize Alibaba to show the operation of a VIE. Alibaba works in an industry where international investors are prohibited. In other words, foreign investors cannot directly hold shares in Alibaba. As a result, Alibaba must establish a shell business in the Cayman Islands, also known as Alibaba. But for the sake of this example, we will refer to this shell firm as Fake Baba. It should be noted that in the real world, Phony Baba is known as Alibaba. Alibaba will now offer Fake Baba contractual agreements over Alibaba's income and assets after establishing Fake Baba. This is accomplished through a complex legal procedure. Fake Baba's contractual arrangements give it power over Alibaba's debts, exclusive call options, proxies, and equity commitments. Fake Baba essentially holds contracts for Alibaba's income and assets, but does not own the stock. Alibaba will now list Phony Baba on the New York Stock Exchange, allowing U.S. investors to invest in it. Alibaba can circumvent Chinese regulations prohibiting foreign ownership by employing this method. Alibaba isn't truly going public on the New York Stock Exchange because Phony Baba is. On the opposite side of the deal, U.S. investors do not own shares in Alibaba directly. Only U.S. investors possess stock in fictitious Baba. This structure is called as the Variable Interest Entity Structure, or VIE structure for short. The VIE structure is used by most Chinese firms to go public on the U.S. Stock Exchange. VIEs have served their purpose effectively for many years. However, there are some serious issues with the structure. To begin with, the VIE structure is legally unlawful because it is simply a loophole that allows foreign investors to acquire stock in China. As a result, China may declare VIEs illegal at any time. Chamath feels that investing in China is a risk that should be avoided due to the VIE structure. Many investors, on the other hand, think that the potential rewards in Chinese equities outweigh the dangers. What's noteworthy is that many value and growth investors regard China as having promise. Cathie Wood, CEO and founder of ARK Invest, recently re-entered their Chinese holdings after selling them a few months earlier. Many investors who had been following Cathie were taken aback, especially because Cathie had earlier stated that Chinese new restrictions were undermining capitalistic incentives. Nonetheless, instead of investing in all Chinese businesses that have disruptive potential, she is now handling the problem in a very unusual way. Cathie is currently investing in Chinese firms with government assistance, especially JD.com and Pinduoduo, while selling Alibaba and Baidu. The CCP's new rules were highly anti-Alibaba, which benefited JD and Pinduoduo indirectly. Indeed, during JD's last quarterly conference call, JD Retail CEO Xu Lei made a dig at Alibaba. According to Xu Lei, Chinese new laws are intended to curb misbehavior, such as chaotic capital development and monopolistic relationships. These objectives are beneficial to JD's long-term business growth. Alibaba's unprecedented antitrust punishment of $2.8 billion was alluded to in the Lay statement. This penalty was imposed when officials discovered that Alibaba was entering into exclusive arrangements with brands that prohibited them from selling items on JD.com. This record fine is directed against Alibaba. As a result, Cathie Wood only invests in Chinese firms that are government-backed. Cathie Wood exclusively invests in Chinese firms that have high government backing, although many value investors do the reverse. Dataroma, a website, records the holdings of all great investors, including Charlie Munger, Bill Gates, Bill Ackman, Manish Prabhai, and many others. These investors have outperformed the market in the long run and are typically worth considering. Alibaba was the top buy for all super investors in the second quarter of 2021. Manish Prabhai, Guy Spier, and Bill Miller are among the successful long-term investors that acquired Alibaba. In the first quarter of 2021, Warren Buffett's right-hand man, Charlie Munger, acquired Alibaba stock, which is remarkable considering that he has openly spoken out against the VIE structure. So, considering the dangers associated with the VIE structure, why do Munger and others continue to buy Alibaba? According to one Charles Schwab employee, if China delists Chinese equities, investors in China will not lose all of their money. First and foremost, in the event of a delisting, Chinese stock investors would retain their holdings in Chinese equities. The only issue is that those investors will need to find a way to exchange them, as the VIE contracts will still theoretically have value. Investors will be able to trade their Chinese stocks over the counter or swap their shares for Hong Kong shares. In the United States, 1 share of Alibaba may be exchanged for 8 shares of Alibaba in Hong Kong. As a result, if Alibaba is delisted in the United States, Charles Schwab will assist its clients in transferring their Alibaba shares to Hong Kong shares, where they will retain some value. The second alternative would be to trade those Alibaba shares over the counter in the United States. In any case, those Alibaba shares would retain their worth. Keep in mind that this isn't the worst-case scenario for Chinese stocks being delisted. Many investors feel that the nuclear option of a delisting would never materialize. This is because delisting Chinese equities would trigger World War III. Aside from the delisting risk, a lot of Chinese firms are fundamentally solid. Therefore, you should be more concerned about survival in your portfolio as a whole if World War III breaks out. Even Manish Prabhai, a hedge fund manager who has allegedly averaged a return of 25.7% per year over the last 18 years, feels that Alibaba's fundamentals are stronger than those of the top tech companies in the United States. Manish has committed almost 20% of his portfolio to Alibaba. Thus, this is a significant investment for him. With that stated, there are some major dangers to investing in Chinese equities, and no one knows what laws are on the way except the Chinese government. Charlie Munger argues that China is not motivated to destroy its own industries. Therefore, any laws are unlikely to have a substantial influence on the fundamentals of Chinese enterprises. Munger has put his money where his mouth is, allocating around 17% of his portfolio to Alibaba. So if you're willing to take the risk of investing in China, go ahead. Chinese equities have the potential to deliver enormous returns, and they are now trading at a massive discount, which, although somewhat justified, is likely an overreaction. Let me know what you think in the comments below if you think it's worth investing in Chinese stocks. As always, if you enjoyed this video, please hit the like button and subscribe. I'll see you in the next one.